So when yields were selling off, this instrument or this index called the Move, which I'll get into details about later. What it's tracking is really volatility in the U.S. Treasury debt market on a forward-looking basis. So what you're tracking here on this chart is the price of derivatives or options that are used to hedge against U.S. Treasuries. So 2 years, 3 years, 5 years, 10 years, 30 years. This index is constructed to take the implied volatility, which is an equivalent way of saying the price of risk, if you will, for hedging U.S. Treasury volatility in the bonds themselves on a 1 month forward basis. What does that mean in practice? Well, what it means is your major financial players who were using these instruments. So when you think about an implied volatility on an option or a swap or similar derivative instrument on a U.S. Treasury, why would you use that? You use that if you're a major bank or financial institution to hedge out risk of, could be your own bond portfolio specifically, or it could also be kind of a hedging instrument to hedge out risk of, creating other credit downstream. So mortgages, long-term debt, project finance, all types of things. And when you see this index start to go up, it means that cost of hedging is increasing. And when you see it start to hit levels like 140 or 135, like breaking through, what that means is it is getting extremely prohibitive from these financial institutions from hedging the risk in their treasury book. So as soon as this gets super elevated, you'll start seeing bonds, in particular U.S. Treasuries, but also all credit, like liquidity starting to back away. Economic transactions not get done because the cost of hedging out interest rate risk is becoming prohibitively high. And you start risking, financial seize up throughout the system. So that's what we saw, the buildup after that initial reaction to the Liberation Day announcement in the Rose Garden, which seems like a distant memory at this point, but it was only about 2 weeks ago, which is somewhat surprising. It's like, in this kind of era, days are weeks, or days are the equivalent of weeks or months. It seems like time just goes very, very compressed, and a lot of action is occurring in a very small amount of space. But this was only 2 weeks ago, and really that is a key indicator that would tell if you're the front runner responsible for driving these parties, well, it's time to pull back, step it down a little bit, let markets cool off. And we called that in last week's episode, right, with that analogy to that boxing match, Hagler versus Hearns. The bell rang after round one, and this is exactly what we've seen in the week since last Thursday. We've seen the move drop considerably. So as of earlier today, when we screenshotted this on the terminal, the move had fallen down to 119. Now that's still a very high level, but it's really the rate of change and direction that is the key. So I would say we're still at a not an extreme reading, but it's still on the above average end for sure. It's not necessarily easy to get hedging transactions through. If you're a financial system, it's still very expensive because there is still a lot of risk in front of us as these trade negotiations and currency negotiations continue to play out. But in the bond market in particular, over the last week, this has been kind of currently commensurate with yields coming back in across all areas of the curve. So 2 years to 30 years, yields have traded lower. You've seen credits, just from my personal anecdotes as a trader on, say, electronic all-to-all platforms. The last, say, like April 2nd to about, I'd say Monday this week or Tuesday, was one of those nice windows. If you're on the buying end transactions. It's very good for you if you have the capacity to absorb the credits that the rest of the market is kind of like spitting out like a pinata getting hit. It was a good time, but I've noticed, as move and other volatility measures in the treasury market have come in, that's slowed down for the time being. So all in all, we've got a week of kind of settling in. As we talked about last week, we can't run up dialed at a move 140 for long, right? You're really risking the wheels falling off the bus in the sense, and that's really at the core of the financial system and treasuries, and that'll just continue to work its way down across all asset classes, even equity markets. So that's been the key headline this week, I'd say, from the bond market perspective, has been kind of a settling down, if you will.